And we're back here on the Prince of Investment. I'm your host, Prince Stacks, the Prince of Investing, coming to you guys and girls live from the beautiful city and state of Denver, Colorado, via the awesome state of Honolulu, Hawaii. Ladies and gentlemen, we're back from the break. And before the break, we talked about the history of stock crashes. We talked about the history. We broke down every major stock crash that we saw in the U.S. market. We talked about why that stuff happens. Now we're going to get into why everybody tuned in today. How do you lose money? And if you know how you can lose, you can know how you can make it, right? And we're going to talk about what are some of the things that we did or the government did to stop some of these market crashes. Because every time we had a major market crash, here come the regulations, right? So first, ladies and gentlemen, the people that lose money. We saw the movies. We see it in the movie. Hollywood has done a great job of showing people jump out of buildings, lose their minds, go crazy, all this other stuff like that. But you have to ask yourself this question, ladies and gentlemen. Now you got to ask yourself this question of, well, Prince, how did they lose their money? I don't want to lose my money. These are the people that lose their money when stock market crashes. Number one, you sell when stocks are down. You brought Amazon for $3,000 per share. Amazon during the market crash has fallen to $1,000 per share, meaning you are down $2,000 per share. You see the market is crashing. All this bad news is going on. You think the world is going to end. Bad press is going to come. All these things of, Amazon is way overvalued. All these things like that or whatnot. And guess what? You sell your Amazon. Now you take a loss. When stocks fall, it's the difference between losing money and losing value. Right now, I purchased my house. Let's say if I purchased my house for $100,000, right? Somebody send me an email and says, or somebody give me a proposal to buy my house for $50,000. Does that mean I've lost $50,000? No, that means that the value of my house has probably dropped for $50,000. But if I don't sell it, I don't lose money. So selling after the market crashes or when the market crashes, just saying, you know what, I should have had this thing. I don't know what's going on. Maybe going back to what we spoke about before the show of why do stocks crash? Your emotions get in the way and it's very liquid. You're very emotional. And guess what? You have the liquidity to be able to sell it. You have the option, the liquidity, meaning you can go in and buy and sell at a moment's notice. So you miss the emotions and your finger can buy and sell it at any time. So you just say, I don't want to lose anymore. I want to stop my losses. So you sell in a down market. That's number one way. Number two, margin, margin, margin. Some people may know exactly what I'm talking about. Some people may not don't know what I'm talking about. Margin, if you do your history back into 1929, that's what caused Black Monday. Not Black Monday, I'm sorry, Black Tuesday. Black Monday was 1987. On Black Tuesday, what happened in 1929? It just became a way of life to save up $1,000. Once you got $1,000, you can use margin, and a margin will let you trade with $20,000 or $10,000, hypothetically speaking. Now you had only had $1,000 of real money. Now you have borrowed money. Now you can trade the market with 20,000. Why did people do this? Because your money can grow a whole lot faster. If I had $1,000 and I made 10% off of $1,000, I made $100. But if I have $20,000 and I made 10% of $20,000, I just made $2,000. So it's a fast and quick way to double and quadruple your money. So I had $1,000. I leveraged it up. I used all this margin. Now I'm trading with $20,000. I earned 10%. Guess what? I've just made $2,000 off of $1,000 investment. Doesn't sound like a bad idea. Now you put this on steroids. People were doing this with 100,000 and millions of dollars, right? Of leveraged margin money. When you have margin money, right? When you have money that is on margin, what happens? If you had $1,000, you borrowed $20,000, and now you lose $10,000, you have just quadrupled. You just made your situation 10 times worse because you only had $1,000 and now you owe $30,000. That's what happened to a lot of people. When the market started to crash, people lost everything because the first decade and 20 years before that, that was just a way of life. And guess what? You could do that today, but you can't do it as strong as you used to do it back in the day. Nowadays, if you have $100,000, guess what? You can leverage up and trade with $1,000,000. So if you have $100,000, you have $1,000,000 account to be able to day trade. People do that all the time today. So this is how people lose money because guess what happened? While the market is down, when you have margin, you don't have the option of paying back the loan when you want to. You have margins that may have gotten called away, meaning that the person that lend you the money saying no, you must pay me now, meaning you can lose a bunch of money at any time. Margin number one, selling when stocks go down. Two, margin. Number three, speculative trading. What is speculative trading? Margin is a way of speculative trading, but also with options. Buying and selling derivatives. Derivatives are options. When you buy a call option or a put option, yes, you can make a lot of money, but guess what happens when you have margin and options? Margin and options come with a time, meaning that I have an option, but the option is going to expire. What if I have an option on the Nasdaq, right? I'm thinking the Nasdaq is going to go up, but my option expires in October. Let's say if the in October the markets continue to go down, my option can expire worthless, or I can lose everything I had into it because of what? Timing. When you have time with option trading and margin, you have increased your risk because of time. Right now, tomorrow, the stock market just may crash. It may jump up in January. But if you have an option, you don't have the option of just waiting and waiting and waiting and waiting and things get better. You're going to lose money in most cases. So time. Now, another one, short selling. What is shorting the market? Going long on the market is meaning betting it's going to go up. That's called a bullish trend. A bear market is when the market you think is going to go down. This is what a short seller does. A short seller is someone who bets against the market. I'm going to try to explain this. Hopefully, it's not too complicated, but it should be rather easy. So, for prime example, let's take a pair of skates. A pair of skates go for $100 in Walmart. So you go over to Walmart and you say, "Hey, Walmart, these pair of skates cost $100, right? Can I borrow these pair of skates and pay you back in December?" Walmart says, "Sure." They lend me the skates. I take the skates off of the skates that I borrow, and I go sell them to Tom down the street for $100, right? Tom gives me $100. So look, I made $100 off of something that I don't even own. Great for me, right? But Walmart, they want their skates back by the end of December. So what happens is, let's say the price of these skates drop from $100 all the way to $50. So guess what I do? I go to Walmart, I buy the skates for $50, and then I fill up Walmart's inventory. Now, if you just look at that, in the beginning, I borrowed skates for $100. I sold them for $100, meaning I collected $100. The price of the skates dropped all the way down to $50. I walk in with the $100 that I made. I walk into the store, buy them for $50. I go to Walmart, give them the same exact skates back. I made $50 off of something I didn't own. I borrowed something and sold it. That's the profitable side of a short seller. Now let's look at the opposite side. I borrowed the skates for $100. I sold them to Tom for $100. I collected $100. Now let's say if these was a rare type of skates and they had gold trimming. These was a rare type of skate, and the skates went from $100 all the way to $500. Walmart still wants their skates. So I only made $100. I have to go pay $500 for these skates to be able to give back to Walmart. So you can see when the price goes down, I made money. But when the price goes up, I can lose money. The crazy thing about shorts is if I borrow something for $100 and sell it to somebody for $100, the max they can go down is $100. The max I can make off of this is $100, right? So now when you look at stocks, right? When you look at a market, so people bet against the stock. They bet that Google is going to go down. They bet that they short Amazon, they short Google, they short all these companies. They bet they're going to go down. If the companies go down, great. But we all know tendency on good companies that go up over time. Let's say if their timing is off and the stocks just continue to go up. Now they lose. So those are the people that lose money. So when you look at it, the people that lose money are the people who sell in a crash market. You also have people who buy on margin, which is borrowed money. People who short sell. I just went through the terms of short selling. And also people who buy leverage bearish ETF, betting against the market on a consistent basis. Usually those people are the ones that lose money over time. That's how you can lose money. But if you buy great companies that are not overvalued and you just hold them throughout a bear market, you can avoid or limit yourself of losing money. You might lose some value, but you won't lose money. What did the now with all these market crashes that I went through, what did the companies or what did the country do? Regulatory wise, one thing that the company did was, well, not the country, but the country did, not the company, but the country. President Roosevelt in 1934 created the SEC. This is Security Exchange Commission to oversee and to build confidence into stocks. Because back in the day, anybody can get on the stock market. People list companies that wasn't good. They didn't have the internet. We didn't have information. So they created a governing body to look over the market. The second thing that they did was they created circuit breakers. If you remember back in March, you heard of these circuit breakers. Circuit breakers go off when they won't let the market, if the market falls 7% within a day or 13% or 20% drops, when they see a 7% drop on the S&P 500 within one day, the circuit breakers stop everybody from trading and nobody can trade for 15 minutes. This to stop massive sell-offs. So now if stocks start to drop, boom, they stop everybody. They make everybody take a 15-minute break to resume trading. If it drops again, boom, they stop everybody. If they hit 20%, they take the whole day off. So that's one thing they did, the SEC did, to stop the market from having these massive sell-offs that we've seen in the past that threatened the livelihood of a lot of people. Ladies and gentlemen, boys and girls and children of all ages, I hope you guys and girls love this episode. We went through the history lesson of all the stock market drops, the major drops that happened in the U.S. market. Then we also went through why did these things happen. We talked about the emotions, the liquidity, the fear, the overvaluedness. And then we talked about the people that lose. How do you lose money when the stock market crashed, right? We talked about people who selling in a down economy, short selling, margin, speculative trading. And we talked about some ways to avoid it. And then we ended it with what did the government do to prevent this from happening in the future or via policies and things like that. That's going to conclude today's episode. Until the next video, podcast, cartoon, or whatever else crazy you see me doing around the globe. My name is Prince Dykes. And I'm the Prince of Investing. Until the next video, podcast, or cartoon, peace, be safe. I'm out, and thank you.